Okay, so, alright, so obviously we're looking at a MAC paper. Remember, the paper's out of 100 marks and you've got 2 hours to answer these questions. Obviously look at the easy bit first and start with that. So when looking at this October-November 2016 paper, you'll see the breakdown is pretty similar to the one that we saw last week, except you've got 5 questions instead of 4. Okay, so the questions here are a little bit shorter. They're not as long, and they're not carrying as much marks in terms of weighting. Okay, so the first is question 1, which is multiple choice. That's an easy 10 marks. You should be able to get that just for knowing your theory. It shouldn't take long. 12 minutes is your time allocation. And we've got the first question here looking at risk. Okay, so they said Clubstone College is a private school which was founded 4 years ago. Okay, so it's established already. It's been around for 4 years. An amount of 5 million is required to complete the school building and establish the required sporting facilities. Okay, so they want to expand. Okay, this is CapEx, capital expenditure. They say they want to apply for a loan at a rate of 15%. Then they ask you, what is the method called to identify risks when the college uses scientific methodologies of measuring specific risk exposures by using tools selectively examine actions, performance, and events to measure their safety culture? Okay, well, that will definitely be a process of diagnosis or diagnostics. Yeah, so it's like a doctor. A doctor would diagnose a specific illness. When looking at risk, you do the same thing. Okay, you need to look at all the different risk exposures. You need to look at the different tools to examine and to basically investigate. So definitely C there, 1C.
Yes, sir.
Okay, so 1.2, with regards to the risk appetite, should a college apply for a loan? Which of the following statements is true? Okay, so 3 are false, 1 is correct. And they're looking at risk appetite. Their risk appetite is low if they apply for the 100% loan amount on a fixed contract for a period of 5 years at a fixed rate. Okay, would that be low? Well, this is a 100% loan, so you've applied for the whole loan at a fixed contract, a fixed rate. Is that a good or bad idea?
I think that's a bad idea.
Well, it's a bad idea if you expect the rates to fall. It's a good idea if you expect the rates to rise.
Yes.
So if you can lock in a rate for 5 years, it's not such a bad idea as long as the rate is very low when you lock in that rate.
So because this is a fixed rate, we would be...
It's a possibility. It could be right.
Yes.
Okay, I like it because, as I said, but you see, they don't give you enough information, but I'm just discussing it. I'm saying, if we fix the rate for 5 years and it's a low interest rate, then that's good.
Yes, sir.
Okay, because if the rates go up, I'm not going to be affected because I fixed the rate. Right, but the problem is, if the rates come down, then that's a problem. Right, and the rate we know currently is 15% per annum. Okay, which is just a bit higher than prime currently. Right, but obviously rates can be a lot higher. Rates can also be a bit lower as well. But we don't know what's going to happen with the rates. Okay, so A, possible. We know risk appetite low. Well, it wouldn't be high, okay, because fixing the rate would be a good idea as long as the rate isn't going to fall or decrease. Okay, B, risk appetite is high if they sign the loan agreement for the full loan amount before compiling a detailed cash flow forecast. Okay, that's obviously a problem. Do you agree?
Yes, sir.
Okay, so if you're signing a loan agreement before you've done all the analysis, that would be a bad idea. It would be considered high risk. Yes. That one's also looking quite good. C, their risk appetite is high if they sign a sponsorship for the total amount of the loan. Okay, well, if it's a sponsorship, do you agree? A sponsorship doesn't have to be paid back.
Yes, sir.
Okay, so that would actually be low risk, not high risk. If someone's sponsoring you, you're not going to have to pay them back in terms of the loan or the capital that you've received.
Yes, sir.
Okay, so C's out. D, risk appetite is low if they decide to apply for the loan before they have final numbers of registered learners. Okay, that's spelled incorrectly. It should be learners. Okay, it's a school. Right, so obviously here the risk appetite would be not low, it would be high. Alright, if they don't know what the number of learners are. Okay, so it's between A and B here.
Okay. Yes, sir.
Okay, so looking at A and B, the one that I like better would be B. The risk appetite is high if they sign the agreement for the full loan amount before compiling a detailed cash flow forecast. Okay, that's definitely high risk. Right, A is a possibility, but we don't know what's going to happen with the rates. So we wouldn't say it's low risk. It could be low risk, but we don't know enough. Okay, signing an agreement before you've done your analysis in terms of cash flow, that's a bad idea. That's definitely high risk. 12B. 1.3, not 12, 1.2. Okay, 1.3. Which one of the following statements does not describe the suitable risk responses if you assume the college's risk appetite is low? Okay, so low meaning there isn't a lot of risk here, okay, or they don't want a lot of risk. And they want the one that's not describing suitable risk responses. So not describing a suitable risk response when the risk appetite is low. Okay, so if the risk is low, what are we going to do about that in terms of the response? Okay, we want to know which one isn't part of those responses. A, risk not able to pay monthly interest payments. Response for a high inherent risk rating. Compile detailed cash flow forecast before applying for the loan. Okay, we would have to do that. Right, so risk not able to pay. So if we can't pay our interest, what would our response be? Well, there's high inherent risk, meaning we're going to have to analyze our cash flow. That's something that we would do.
Yes, sir.
B, risk apply risk. Okay, so apply for loan at a new financial institution, AFRO bank, and the response for a medium inherent risk rating, get approval from the management to consider other financial institutions. Right.
So would this be like you already have a loan with the bank, now you're trying to take another loan out?
No, you're applying for a new loan.
Oh, okay.
Okay, so the risk is apply for a new loan with a new bank.
Yes. Okay.
Okay, what would your response be? Okay, so the response here was, well, for a medium inherent risk rating, you need to get approval from the management to consider other financial institutions.
Yes, sir.
Okay, would that describe low risk appetite in terms of a response in terms of your risk appetite being low?
Yeah, I think so, sir.
Do you agree?
Yes.
Because if my risk appetite is low and here I have medium risk, someone else needs to approve it. Do you agree?
Yes, sir.
So my response would be correct. Okay, number C. The risk over-capitalizing on the new school facilities. So that means we're building too many facilities. The response. For a medium inherent risk rating, compile detailed cash flow before making the final decision. That's something that you would have to do.
Yes, sir.
Okay, and then number D. The risk is not able to repay the loan capital amount. Okay, so if we're not able to pay the loan capital amount, what would our response be? Well, the response, for a high inherent risk rating, accept the risk. No, we wouldn't. We wouldn't accept the risk if it's high, if our risk appetite is low. Does that make sense?
Yes, sir.
Okay, D. Okay, 4 and 5 looks at Lindiwe's clothing business. Okay, it's a clothing company in SA. They import dresses from Spain for important occasions and celebrations. Their profits are dependent on the fluctuation of currencies. Okay, so that's a currency risk. That's an exchange rate risk. Management was shocked when they heard the following message from the broadcasting news. The Deputy Minister in South Africa announced that 3 of the ministers of the cabinet will be replaced in Parliament. Okay, obviously that's political risk. Right,
Yes,
so
sir.
1.4. Which of the following combination of risks will Lindiwe Clothing be facing? Political, definitely. Information, I don't think so. Market risk, probably not, but possibly. But market risk is looking more at the demand and supply. So I don't like that one. Business risk, political risk, definitely. Social risk, no. Business risk, possibly, because this could affect her business, but it doesn't
Yes.
directly affect the clothing industry, unless it's like a minister of, let's say, trade and industry, perhaps. Okay, they just
Yes.
said ministers will be replaced. We don't know which ones. In terms of compliance, possibly. Financial, possibly. Market, supply and demand, maybe not. Not the best of answers. Economic, yes, because the economy would be affected by changing ministers in the cabinet. Political, definitely, because there's uncertainty. And financial, yes, because the currency or the rand is going to be affected. So yeah, a D would be the best. Lindiwe Clothing has to comply with the number of acts and regulations being an importing company. Which one of the following statements relates the best to compliance risk? Okay, so compliance risk is looking at meeting certain rules and regulations.
Yes, sir.
Okay, so A, it can lead to going concern problems, possibly, but sometimes compliance can actually help keep you in business. So I don't quite agree with that one. B, it is out of the control of management. Well, that's definitely. I mean, remember, management doesn't set the rules. Government does. Outside regulators do. C, it can result in inappropriate decisions being made. No, not inappropriate. It would be appropriate. If you're complying with certain rules and regulations, then you're going to be making the right decision. So not the best of answers there. And then D, it can lead to the use of invalid or poor quality information. No. Okay, it wouldn't be poor quality information. Compliance risk, in terms of complying with numbers of acts and regulations, would lead her to valid and good quality information for decision making. Yeah, so number B. It's out of her control. Okay, question 2 is out of 20 marks. It's 24 minutes. They've given you two parts, A and B. Always look at the required first. There's the required. Explain the leverage effect to the management of Fresh Limited by referring specifically to the differences in the amounts of debt, interest, net profit, return on equity of the scenarios in tables 1 and 2. Supply management with a recommendation on how they could obtain their optimal capital structure. Okay, so that's what we're looking at doing here. It's a theory question. We're looking at debt, interest, net profit, return on equity. But if they're asking you about all four of these, make sure you address all four of them. And then give them a recommendation on how they can obtain the optimal capital structure. Right, first things first is understanding what's happening here. Okay, so we go back and we read. Part A. Fresh Limited is a company supplying water. Okay, bottled water. They supply bottled water to drought-stricken cities where the El Nino extreme weather conditions cause low rainfall and residents have no water to drink. This is part of their long-term sustainable value creation. Management needs to make decisions regarding the funding of 2 new water pumps to supply in the higher demand for water. Okay, they want to achieve the optimal capital structure and need more information with regards to the leverage effects. Okay, so leverage is looking at either there's two types of leverage. You get financial leverage and you get operating leverage, and those two are grouped together, and that gives you total leverage. Okay, that's the theory that we looked at a few weeks back. Okay, in the table they present the project situation when only one water pump at a cost of 250 million is funded with debt, with only debt at a rate of 11%. Okay, remember, just to revise some theory, debt has a tax benefit because interest is tax deductible. So you always have to take the after-tax cost of debt. Table 2 looks at when 2 water pumps cost a total of 450 million and acquired by using only debt. Okay, so again, we're using only debt. The interest rate of the debt in table 2 is 13%. Okay, so slightly more. Okay, it would be more because you're raising more capital. Okay, the more capital you raise, the more expensive it's going to get. And then they say it is assumed that the additional pump will generate the same operating returns as the one pump in table 1. Okay, so both pumps are going to offer the same benefits. Right, so now we understand the scenario. We've got two situations. Situation 1, there's the funding that you require, there's the interest rates. There's the funding for the second project, there's the interest rates. Right, the total assets that they have, 350 million. Total assets they have there, 550. Okay, they want us to explain the leverage effect to the company of Fresh by referring specifically to the differences in the amounts of debt. Okay, so let's start with debts. Okay, you tell me, what is debt going to do to leverage? Will debt change your leverage?
Sorry, sir. I forgot that I had muted myself.
Okay.
Yes, debt will change leverage, sir.
Okay, how will it change leverage?
Well, I think it'll change leverage in the sense that the leverage, well, most of the leverage will be with the person offering or giving you the debt than with you, I think so.
Yeah, so financial leverage is going to change, obviously.
Yes, sir.
Okay, because using more debt is riskier than using equity. Okay, so financial leverage would be affected by your level of debt. Okay, debt will increase the default risk, but debt will increase the return on equity for shareholders. Okay, so there's pros and cons to it. Okay, but obviously debt would have an impact on financial leverage. It would increase risk. That's probably the biggest thing to discuss here, because leverage is focusing on your percentage of debt and equity. Okay, so now
Yes,
they want interest. Okay, so now we look at interest. Is interest going to affect leverage? Well, operating leverage, financial leverage not so much, because if I'm looking at financial leverage, you're looking more at the extent in terms of how much debt are you actually taking out. The interest, this is tax deductible, so the more interest we pay, the more, inverted commas, interest we can deduct. Okay, so there's a tax benefit here for paying interest. Right, so there's actually nothing wrong with paying interest, because as long as you're operating as a business, paying interest is actually going to help the business indirectly. Okay, because yes, you have to pay the interest, but by paying the interest, you're reducing your taxable income. Right, so you end up paying less tax ultimately. Right, so interest isn't necessarily a bad thing. It just depends. So it would have an impact on leverage. Okay, I would say more on the operating leverage, because you're looking at its impact on your ability to operate, meaning the tax deduction would affect the operating profits. Okay, so that would be a more specific impact on leverage than the ability to pay off the debt, okay, which is the default risk. Okay, explain the leverage effect. Now you look at net profit. Okay, net profit, I would probably bring in DuPont here. I would look at ROE equals net profit margin times total asset turnover times financial leverage multiplier. Okay, and I would be looking at net profit here as being as one of the figures that will affect that. Okay, so if NPM, net profit margin, increases, this will increase the net profit, well, the return on equity. Greater net profit margin will increase the return on equity for shareholders. Okay, so there would be leverage here, right? The leverage would be real in terms of the benefit that the shareholders would get if you were able to increase the margin on your sales, right? So meaning I can sell every single product at a higher profit markup. That would definitely affect your operational, your leverage, okay, your benefits.
Yes, sir.
Okay, and then your ROE, explain leverage in terms of ROE. Well, then that's DuPont. Okay, ROE is affected by 3 components. Okay, I would discuss the DuPont model here in more detail. Okay, I'll be looking at those components that make up the return on equity. Okay, so return on equity isn't specifically, it doesn't specifically affect, let's say, leverage as such, because ROE is just a measure. It's more a measure of benefits, and leverage would affect the ROE. Okay, so it's actually the other way around. It's more the effect than the cause. Right, the cause of leverage would be how much debt or equity you have. The cause of your leverage would be how productive are you with your goods. Okay, your assets. Okay, total asset turnover. Total asset turnover is looking at, well, how much sales am I generating from the goods that I have? Okay, from the resources that I have. And then the financial leverage multiplier is looking at the interest side of things. Okay, taking out debt, taking out other people's money, okay, or using other people's money to generate more return for the owners. Right, so that's more the cause than the effect. ROE doesn't specifically affect leverage. Leverage affects ROE. If that makes sense, it's the other way around. Okay, so explain the leverage effect to management. Maybe just to check the textbook and see if there's a definition in the glossary. Normally there is leverage, because then that's always a good thing to include in your solution as well, as a additional consideration. Where's the glossary? Okay, I've got financial leverage effect here. I'm looking for leverage. Okay, they just talk about financial leverage. That's it. It's on page 38 of the second book. Yeah, that's it. Okay, there's no specific glossary term for leverage here. Right, so if you wanted to, you could maybe rewrite or discuss some of the theory here in this particular chapter. Maybe just to take this through to our notes here. If you wanted to, you could maybe discuss some of the theory on page 38 relating to this financial leverage. Okay, but remember here they're just talking about leverage in general. So you could also talk about operating leverage as well. Operating leverage. Let's just get that one as well. Okay, interest cover. Operating leverage. Okay, the leverage is the debt and equity ratio. You could maybe talk about that. I probably wouldn't though, because that's a financial ratio. Here you're looking more at the effect. So how will debt and equity affect the actual return on equity for the business? The leverage effect here, they talk about it under the ratio analysis, I see, but they don't give too much theory relating to the actual leverage effect. They talk about financial leverage separately, and then they just talk about leverage. They don't really talk about the operating side of things in too much detail. Okay, so yeah, so I think that would be fine there. Let's just go back and see in terms of recommendation, how could they obtain the optimal capital structure? Okay, well, optimal capital structure is going to be looking at the mix of debt and equity that maximizes the return. That's what you're looking at. That yields the highest return. Okay, that's what you want. So if I'm looking at leverage, if I'm looking at a recommendation, the company is going to have to achieve the optimal capital structure by implementing debt and equity and checking which creates the biggest return, which would be the return on equity, potentially would be the better option. Okay, so looking at this, if I look at table 1 and I look at table 2, which table generates more return on equity?
I think it's table 1.
Yeah, table 1 actually, because you can see that the return on equity here is higher than the return on equity here.
Yes, sir.
Okay, so even though we're spending 11% interest, okay, on 250 million. Okay, the net profit here is still bigger than the net profit there as well.
Yes, sir.
Okay, so even though we're investing more, by investing more, we're obviously going to have more costs, and more costs are obviously going to affect the business as well. So in terms of value, looking at what we have here in terms of the analysis, you can see that table 1 has a greater net profit. Okay, return on assets is the same, so nothing has changed there. They still have an amount of assets, meaning their resources. So
yes,
I either have 350 million resources or 450. Okay, notice, having more resources, did that generate more return? No.
No, sir.
Okay, have
because
a look. Here
we
had a lot more resources, but we weren't generating more return.
Yes, sir.
Here, we had fewer resources but generating a bigger return.
Probably using them inefficiently.
Exactly. Yeah. So option 1, or table 1, shows a better overall utilization, utilization of resources, because the ROE and the net profits are higher, even though we have less resources. Table 1 has more leverage than table 2, because a greater return is achieved with smaller or with less resources. Okay, that's why it's not about how much resources you have, it's about what are you actually doing with those resources, how productive are those resources, how efficient is the operations. Okay, so obviously this company is a lot bigger, table 2, they're proposing a much bigger project, okay, but not reaping the same benefits. Right, then B is calculations. Okay, so A was theory. Now we've got some calculations. Part B. First question says, calculate the market value of the debentures. That's easy, right? That's time value of money using your financial calculator. Again, they specifically say use mathematical formulas here. Again, I don't know how particular they're going to be in terms of, for example, if I show the financial calculation and I get everything right, would they give you 0 just because you didn't use a formula? or wouldn't they? I don't know, so I'm not too sure what advice I should give you. They do say that you should set your calculator on 4 decimal places for doing calculations. Okay, and obviously round off answers to 2 decimal places. Okay, so if I'm looking at the debenture finance, I'm going to be focusing on identifying different variables. Okay, so there's the first bit. Management of Chikani Limited bought 250 million par value debentures. See, there's your 250 million par value. There's your FE. $250 million. Okay, there's enough zeros there. Okay, the annual interest payment is 13%, and the debentures are redeemable after 6 years at face value. What else do they say in the question? Well, they tell you that the beta is 1.1, risk-free is 9%, market rate is 18. When I see those three in the same question, I know I've got a CAP-M calculation.
Yes,
okay, as soon as you see that, you know you've got CAP-M. And CAP-M is actually the second bit. See that?
Yes.
Okay,
yes, sir.
Right, so while we've read it, I'm actually going to do the calculation for it. So this is A. Let's do B while we've just read it. Okay, so CAP-M is required return is risk-free plus beta.
Market minus RF.
Correct, yeah, market minus risk-free. Okay, so required return equals risk-free of 9%, beta of 1.1, market of 18. So 9 plus 1.1 times 18 minus 9, close brackets, equals
18.9.
Yes, that's good. 80.9 is already answer to B. Okay, so you get 3 marks for doing B. Just by remembering the formula for CAP-M. Okay, so we've actually answered B already. We still need to go back and answer A. The current market value, okay, we need to discount that back in time. Okay, and they tell us that the current market value of similar debentures is 12%. There's it there. Similar debentures. So your I is 12%. Solve for PV. Okay, so on my financial calculator, I'm going to calculate, go to compound interest, N is 6 years, I is 12%. Your present value is what you're solving for. Your payment is 13% of 250 million. Future value, 250 million. And then you solve for the present value. And your present value comes out as that. Let's see what that is. Okay, it's 260278518.30. Okay, so 260 million basically.
278,518.
Yeah, it's just over 260 million. Right, so obviously are these debentures selling at a premium or a discount? Did they ask for that? No, they didn't. They just did calculate the market value. Okay, but if you had to answer that question, these debentures are selling at a premium. Okay, why are they selling at a premium? Because their coupon rate of 13% is more than the market rate of 12%. Okay, so premium debenture financier. Okay, but that's it. That's 6. And then C, calculate the WACC. That's easy. Weighting times cost, weighting times costs. Okay, that's what you're going to be using to calculate the weighted average cost of capital. Okay, I need to go back and I need to read the question. I need market value, total market value. So let's do a side calculation. Side calculation. Total finance. Is broken up into debt and equity. Okay, so how much debt does this business have? 250 million. How much equity does this business have? 150 million. Do you see that?
Yes, sir.
So total 3 plus 1 is 400. Okay, so now we can work out a percentage of. If you wanted to. You don't have to, but I'm going to show it anyway. Obviously it's 100%. Okay, and then obviously 250 divided by 400. 62.5%. And then 150 divided by 400 is 37.5%. Okay, so they're using more debt than equity. Do you see that?
Yes, sir.
Okay, so you've got the weightings. Right, so you could show the weighting here as, in terms of debt, 0.625, or you could have just shown it as the 250 million over the 400 million if you wanted to. Okay, I'm going to show it as that. Okay, then we need the cost. What is the cost? Well, we worked out the one. Did they give you tax here? We need to read the second paragraph. Current market value of Chikani's shares is 150 million. The last dividend was that per share. It is anticipated that the earnings and dividends of the company will show constant growth of that, and a beta of 1.1, risk-free. Okay, so that's what we read earlier. That's fine. Oh, there is tax here. There's it. See, there's the tax. I'm looking for tax. There's tax. 28%. See that?
Yes, sir.
Okay, so we're going to need that as part of the question. Okay, so after tax will be cost of debt minus the tax. So cost of debt, which we worked out as being, not as being, we were given it, 12%.
Yes, sir.
So 12% times 1 minus 0.28.
So debt, yes.
Cost of debt. Okay, and then times the cost of equity. Do we have the cost of equity?
I didn't see one.
We did. They gave us the beta, the risk-free, and the market rate. That was B.
Oh, yes, yes.
B is that's equity. So that's going to go here. Final answer. WACC comes out to equals 12.48%. Okay, that was for how many marks? 5 marks. Okay, calculate the weighted average cost of capital. Show formulas used in detailed calculations. Okay, which we've done. Right, so this was just time value of money applied to a question. Got that?
Yes, sir.
Okay, so the first bit was look at the debt, then the second was look at the equity. You needed debt and equity to calculate WACC. Okay, question 3 is the long one. Right, we've got a textile manufacturing company. Soft Hearts Limited is expanding their sales to other regions. They're considering purchasing an additional machine, okay, in order to increase capacity. Okay, as soon as I see that, I know I'm dealing with capital budgeting.
Yes.
And this is a decision to expand, not replace. Do you agree?
Yes, sir.
Okay, that's what they said. They said expanding their sales. Okay, the following information relates to 2 machines, pink and purple. Right, you've got the cost, the working capital, the net operating income, the realizable value, and the useful life. Then they're giving you additional information. Let's go to the required first. How many parts do we have here? We've got quite a few parts, A, B, and C. Okay, so A as Soft Hearts Limited is expanding their sales to other regions, they will have to deal with external as well as internal environmental factors that influence the development of the organizational or organizational strategy. The following table contains a description of the internal environmental factors that have an influence on the strategy developed or strategy development of a Soft Heart Limited. Okay, so you've got each of these. Name of internal environmental factor. Okay, so you're going to have to identify the name of these factors. That's what they said here. There's the instructions, NB. You're required to write the specific name of the internal environmental factor described. Write only the number and the description. For example, 1 and the factor. Okay, so how many factors do we have here? 5. Right, so 1, 2, 3, 4, and 5. Okay, all we need to do is identify the factor. Okay, so the first one. It entails employee shared benefits, values, and symbols that can be seen as the glue that holds everyone together for all, the compass, providing direction that creates a common groundwork for teamwork. It presents a language for interpreting issues and events, thereby reducing uncertainty. It gives perceptions, attitudes, behavior which have an effect on business results. They're covering a lot here. If we're looking at the internal-external factor, what would you say? Internal, external here? It's groundwork, right? So that's internal.
Yes, sir. Sorry.
Okay, so definitely internal. We just need to identify which internal factor, though. What is this? Environmental risk. Let's see if they've given anything here.
So is this covering like the environmental, political risks and all those stuff?
It's looking at the factor. Yeah, so name the internal environmental factor. So it's not the risk necessarily, it's more the factor. It's what's causing this. So employee shared benefits, values, and symbols. I'm just trying to see if there is anything in the textbook here. Environmental risk is on page 187, but that just defines what it is. Okay, that's not looking at internal environmental factors to consider.
So then where in the textbook are these factors that...
Okay, there's it. I see factors on page 194.
194. Okay.
It starts on page 193. Pestle analysis.
Oh, wasn't this to identify risk? The factors.
Yeah, it's just different things to consider when operating a business. You need to obviously look at internal and external factors. Okay, here they want us to name the internal factor. Okay, so political is external, economic external, social external, technological external, ecological external, legal external. So that's not it.
So if it were we're gonna name the internal environmental factor as pest or something.
Yeah, we need to give it a name. So here they said it entails employee shared beliefs, values, and symbols that can be seen as the glue that holds everyone together, or the compass provided. So I would say this is strategy or policy.
Yes.
Creates a common groundwork for teamwork. It represents a language for interpreting issues and events, thereby reducing uncertainty. Drives perceptions, attitude, behavior, which will have an effect on business results. To me, that's strategy. I just want to check if there's a better definition of it. Common groundwork. Let's check that. It's not there. Teamwork. Also not there. Right, so I would have to go with internal. So looking at this, what factor do you think it is? Let's see. It's definitely internal. Ratio analysis, no. Working capital, no. Capital investment and budgeting, no. Traditional methods, no. Discounting cash flows, no. Risk management, yes. Okay, so here we're trying to name the internal factor. That's all they gave you in the question. Yeah, that's all they gave you in the question. They just said this was strategic. And that's the description that they've given. I would say vision or mission statement, because it drives the perceptions, attitude, and behavior. So mission statement sounds good. It's one of the definitions that in the glossary probably. Mission statement. Let's see what we get if we go mission statement. Because it's internal. There we go. Okay, mission statement in the glossary is on page 220. They say mission statement, a mission that defines the core purpose of the organization by broadly stating the reasons why the organization exists. Here, it entails employee shared benefits, values, and symbols that can be seen as a glue that holds everyone together, or the compass, providing the direction. It drives perceptions, attitudes, behavior, which have an impact on the decision. I would go with mission statement here, or vision. Let's try vision. See if there's a better definition here. Vision, not given. Strategy. Okay, strategy is also here. Strategy is on page 225. And strategy they define here as being choosing long-term activities to achieve the purpose out in a mission statement, ultimately moving towards the vision. See. Okay, let's check vision. Vision statement is on page 226. The vision statement defines where the organization wants to go in the future. Did they say anything about the future here? Well, providing direction, so possibly they could. There's a indirect reference to the future in that question. Anything else that we could use on the textbook? No. Okay, so you could go with either mission statement here. You could go with vision here. You could even go with objectives, maybe. You could maybe mention the word objectives or goals. That could be something that you would look at. Okay, so I would go with mission statement, probably being the best answer. Then I'd be looking at the next bit, which is the strategy, maybe as an alternative. Then maybe look at the goals or the how can I put it? The deliverables, things that you need to achieve. Okay, 2. It includes executives and managers who run the daily operations of the organization's organization. Okay, full stop. Leaders should effectively manage soft, hot, limited resources and look for ways to improve the organization by inspiring their employees to do their best work. Leadership should provide the vision, direction, and purpose for growth of the organization. So if we look at the internal factor here, this is looking at the leadership. So if we look at the internal factor, I'd be looking at either leadership or people in that position as giving guidance or giving clues in terms of what they should be addressing or focusing on going forward. Okay, it's almost like the dream part of it in a way. What factor do you think they would fall under?
I don't know. I would have said something like board of directors, but I don't know if that's a factor, because I'm looking at executives and managers who run the daily operations of the organization.
But our board of directors running the daily. That's more of more at a macro level.
Yeah.
Okay. All the people at the bottom, the lower managers perhaps, or the senior managers that are doing the more hands-on work.
Yes, sir, it does, sir.
Yeah, so what factor do you think that would best fall under? For me, I'm thinking maybe strategy here might be better, because this is look at the daily operations.
Yes, sir.
So if it's daily, it's more practical. Or maybe the organizational culture, or the policies. So for 2, there isn't something specific in the textbook. So I would either go with strategy here, organizational culture.
Strategy speaks of like long-term goals, though, so like long-term activities or goals.
True. Yeah, that would be more long-term. So this would be more the short term. So it wouldn't really be a goal. It would be more like a deliverable, yeah. Okay, but if we look at the day-to-day operations, inspiring the employees, providing the vision, direction, and purpose.
Aren't those like managers? I just don't know what
operational management, perhaps, yeah.
Perhaps, yeah, something like that.
Operational management slash, you might want to look at maybe even HR to some extent. Could you mention HR, inspiring employees? Yeah, possibly. Okay, incentivizing employees to work harder, to work better, etc.
Someone who is very hands-on with employees, so probably like their closest bit of management. Operational manager, foreman. No, not foreman, but someone who's very close and on the ground.
Yeah, maybe the policies, you could maybe use that as the internal factor. Okay, 3. It refers to the workplace employees of an organization. It is also the name of the function within an organization that is responsible for implementing strategies. Okay, so this is implementing strategies. Here's the execution. And policies relating to the management of the employees. Over time, the function has changed as management demanded a quantitative as well as a strategic approach to workforce management. In order to gain a competitive advantage, each organization has a different set of circumstances and develops an individual set of policies. These policies should be set in such a manner as to support the organization's vision and their main objective. Okay, so if we look at one word that describes the internal factor, what would you say?
Mission, isn't this a mission statement? Mission or vision statement?
Vision would be more the future, hey? So this is looking at employees, implementing strategies.
Yes, sir.
So implementing strategies.
I'm just looking at that last line where they say policies that should be set in such a manner as to support the organization's vision and their main objective. That was, I read that 2 days ago. It was in the beginning of the first book. It was around strategy and mission statement, something like that. If I can just...
Let's have a look and see.
If I remember correctly. Because in the May-June, they were speaking about what ties. They were speaking about a question that said, what ties vision and mission? I can't remember correctly.
But remember, this is the implementation, hey?
This is the implementation.
Yeah, they said implementation. See, implementing strategies. Responsible for implementing strategies. Maybe board of directors here wouldn't be so bad. Because the board of directors would have to implement strategy and they would have to develop the policies.
Yes, sir.
Possibly. Let's just check if there's a better answer than that. Okay, I see strategy here on page 8 of the first book. The last point talks about displaying a broad conceptual knowledge of the environment. They talk about changing strategies, major changes, trade-offs, competitive advantage, choice of activities. They talk about cost leadership, differentiation strategy, pricing strategy. This wouldn't be a pricing strategy. This would be implementing strategic objective, not that. And that's the summary. That's the end of chapter 1. Then I've got stakeholders, internal, external, connected persons, external stakeholders, and that's the other chapter. That's the new chapter. Yeah, so it's a bit tricky because they don't give you a specific, let's say, topic that they're trying to focus on. What they have done is they've underlined two different parts of the question. So the one is responsible for implementing strategies. That's definitely important. And developing individual set of policies. So who would do that? Board of directors.
Yes.
Yeah, and they said it is also the name of the function within an organization that is responsible for implementing strategies. So board of directors isn't the name of a function.
Yes.
Corporate governance, maybe. No, corporate governance is more looking at ethics rather than developing policy. Operations, perhaps. Sorry?
Yes. No, I was just thinking, maybe isn't there one of their committees that looks at that? I'm just trying to think of maybe a risk committee. No.
Risk wouldn't be looking at implementing strategies. It would be looking at risk management.
Yes, sir.
You could be right, though. Let's just check if there's anything here.
Not the nomination.
Culture talks about the shared beliefs, values, and symbols. Did we have that earlier? Shared values and symbols, no. That's corporate culture on page 24. Organizational leadership. That could be it. Okay, on page 25, organizational leadership includes executives and managers who run the day-to-day operations.
Yeah. Day-to-day operations.
That would be number 2. Vision and purpose, day-to-day, yeah. Organizational leadership, there's the better answer for number 2. Operational management isn't the better answer, it's organizational leadership. That's the best answer for number 2. Okay, inspiring employees could be human resources. Possibly.
Yeah, probably. Yes, sir.
Okay, because HR here on page, if you look at page 25, they say it's looking at workforce, okay, employees of the organization. Do you see that?
Yes,
but
sir.
this is looking at strategies, though. So see, different. But you are looking at employees. See, that's the problem with this. It looks at strategies, but also employees. So, over time and develop. I would go with HR here.
I would, because it also says here, and I highlighted, it says, over time, the function of human resources has changed as management demanded a quantitative as well as a strategic approach to workforce management. So I suppose it could
but I don't see any implementation here.
Policies referring to.
Do you see that?
Yeah.
Yeah. So it's a little bit. It's a bit up in the air. It's difficult to say for certain. What are they trying to focus on? Because yes, workforce employees are here, but then they underline the sentence. Do you see that?
Yes, sir.
Okay, and now obviously HR wouldn't be responsible for implementing strategies. Oh, but relating to employees, yes, though.
Yes.
Okay, so that would be fine. Yeah, if it's only the employees, then that's fine. But if it's broader than that, it's not. Okay, so that's actually fine. That's actually fine. Okay, we'll go with HR there. Okay, number 4, factor that deals with employment relationship, workforce relationships, and refers to the management of certain events such as workplace conflict and the role of organized labor unions. Okay, that's definitely looking at those trade unions and conflict, industrial relations.
Yes.
Definitely. Right, and the last one is looking at the disciplinary procedure and sound label actions. That would be looking at the controls at organizational level, code of conduct.
Yes, sir. Ouch.
Okay, that's it. Not too bad, but it required obviously some revision there. We had to go back to chapter 1 and to look at that, just to make sure that we've got the right categories. Okay, maybe let's just check this one again, number 1. Number 1 was what here? Here's it. Creates a common groundwork for teamwork. Because we know what chapter they're looking at here, it's probably the first one. Where's the first one?
Corporate culture.
What page is that on?
24 of the first book.
Yes, there we go. Got it. Let's just check. Common groundwork for teamwork. Is that mentioned here? Yes. Okay, I would go with corporate culture there. Okay, because now we know where they're getting the answers from.
Yes, common ground for teamwork.
Okay, so just be careful with and that's why past papers are good. Okay, the reason why we're doing past papers is because we can see what questions they like testing.
Yes, sir.
Okay, so it would be a good idea just to remember these headings, because if it came up in one past paper, it might come up in another past paper in a different type of question. Right, happy with that one?
Yes, sir.
Okay, now we've got a nice, simple, easy time value of money IRR NPV type calculation. All we need to do is we need to build our cash flows. Do you agree? That's the most important bit. Right, they want you to determine the IRR of machine pink. Interpolate between, okay, so that's obviously interpolation was one of those methods to get the actual rate. But if you've got the financial calculator, the IRR can be worked out on the calculator. Then show calculations for NPV. Again, NPV can be worked on the calculator. Make a recommendation to management based on the IRR of the two machines as to which machine you should acquire. Okay, so we're looking at pink, and we're looking at IRR and NPV, and then we need to compare the two machines. Fine. Okay, so let's go back to the question. Here's it. Okay, there's quite a bit. We need to just build a timeline. That's all. Okay, so NV, I just want to give you some revision here. Time value of money using timeline. Make sure you draw a timeline. T0, T1. Okay, we need to put everything on the diagram. Okay, so we're only looking at pink though.
Yes, sir.
That's what they said. They said, where's the question now? I lost it. Okay, there's it. Determine the IRR of machine pink. And then they said, show detailed calculations of the net present value of pink. Make a recommendation based on the IRR of the two machines. Okay, so IRR, did they give the IRR for the other machine? Yes, they did. There's it. See that?
Yes, sir.
Okay, so we don't have to worry about purple. We've got the IR. And we don't have to worry about the NPV of pink. We've got it.
Yes, sir.
Okay, but I don't know why they said work it out then. That's strange. You see, they say show detailed calculations of the net present value of pink. Or maybe they just want you to show your workings to get to the right answer. That's possible. So that's the NPV that they got for pink. Do you see that?
Yes.
Okay, then there's the present value. Okay, so they might want the mathematics.
Yes, sir.
All right, so it'll just be present value of your future cash flows minus the initial investment. Simple as that. Okay, but let's work out the rest. Okay, so let's go back to the question and let's put and build a timeline. Right, so the cost price of pink is 3.5.
Yeah, 3.5. Yes, sir.
Working capital required 100. So plus 100,000. Net operating income before tax. Net operating income before tax. That's for the 5 years. So before tax, we need to take off the tax. So net operating income before tax is how much? 450. Okay, what else? Realizable value at the end of the useful life, 488. That's your terminal value. 488. Okay, 5 years useful life. Ooh, too many years. 5 years. That's the end. Okay, what else? Additional information. In determining net operating income, depreciation has already been taken into account. Depreciation is calculated by taking the realizable value into account. Okay, so that means we need to add it back. Okay, so net profit before tax. Let's take off the tax, less the tax. Okay, so how much is tax? 28%. See, there's it. What's wrong?
No, so I just want to ask because in the other question they had something similar, not quite as in depth, but I took off the depreciation minus the tax, and then I added back the depreciation.
Yeah, you do that. You normally would, but here they said in determining net income, depreciation has already been taken into account.
Oh, okay.
So if it has already been taken into account, that means they've already subtracted it.
Yes, so we just have to add it back.
We just have to add it back, exactly. Because in this amount here, this 450 already has the depreciation. Does that make sense?
Yes, sir.
Okay, so I'm just taking off the tax, 28%. Okay, there's the tax. So net operating profit after tax is this minus that, gives you that. And then I'm going to add back the depreciation.
Okay, sir.
Okay, so depreciation is how much? Well, cost price minus the residual value divided by 5. 3.5 minus 488, close brackets, divide by 5 years. Okay, there's the depreciation. So your OCF would equal this plus that. There's the OCF. Got that?
Yes, sir.
Okay. Right, so one we've read. Management is expecting an increase in the estimated net income before tax in year 4 and 5 of 170 and 230 respectively. Okay, so in year 4 and 5, so in these 2 years. Alright, so this will remain the same for those 2 years. Okay, and then it'll change here. Okay, so 450 plus, how much does it change in year 4? 170. Add an extra 170. And then, and 230 in this one. Okay, so in 230, just help me with interpretation. Is this 230 increasing from year 4 or increasing from what it was?
I have a very similar question with the other question as well, sir. With the other, but the way I interpret it is like this. What are you talking about, the increase, right, sir?
Yeah, is the increase on the 450 or is the increase on the year 4 for year 5?
To increase by, I think
the increase is 170 for year 4 and the increase is 230 for year 5.
Yes,
that's how I'm interpreting it.
Yes, so that's how I'm interpreting it as well.
Okay, so plus 2, how much? 220, 230.
230.
Okay, so then that's 850 in those two. That's the increase. Is that okay?
Yes, sir. That's
okay. Right. Okay, so then tax. We need to work tax out. There's the tax. Then the net profits. And then add back the depreciation. There's your OCF. Okay, got that?
Yes, sir.
Perfect. Right, so now we've looked at 2. We've looked at 3. Number 4, straight line of 25% per annum on the cost of the asset. 25%, this doesn't make sense. Okay, because the useful life was 5 years, but then they give you a wear and tear of 25%, which is different. That's 4 years. Do you see that?
Yes, sir.
So normally they should be the same, but if they're different, then that means there's going to be a difference in the taxable income amount, if that makes sense, which is making this a very complicated question. Okay, so let's provide for it. Management requires 16% per annum after tax on the capital projects. All cash flows except the initial capital outlay at the beginning of the year in the concern was given as that. Okay, so if they're telling us that the wear and tear is over 4 years, if the wear and tear is over 4 years, that means you'll claim more in the current year when you have the. But you see, that's not going to affect your accounting. All right, so this is accounting using 5 years depreciation. SARS brackets tax using 4 years. See, that's the only difference. Okay, so there's going to be a discrepancy. It's called a deferred tax adjustment, but I don't think they're going to be testing deferred tax in MAC2602 purely because it's a more complicated concept, and I haven't seen it come up in any of the chapters before this. Right, so I do think that the only reason why they've given you the wear and tear allowance is just to indicate that obviously from a SARS perspective, you're accelerating your write-off, meaning you would get more of a tax benefit in the year in which you write off the assets. But from an accounting point of view, it wouldn't change the question. Right, but from a finance point of view, finance is looking at cash flow. Do you agree?
Yes, sir.
Okay, so if finance is looking at cash flow, you would then be focusing on not accounting, but you'd be looking at tax. When do you actually get the benefit? Okay, so then I would actually change this then in terms of depreciation. Yeah, but you see, accounting is still depreciation. It's not tax. It's still different. You see, because if you're adding back depreciation, you're adding back what you're writing off, which is the accounting treatment, not the tax treatment. If that makes sense. Okay, I'm gonna just put a note here, extra. Okay, if wear and tear is greater than counting depreciation. Okay, what does that mean in terms of cash flow? Well, in terms of cash flow, the business claims more in the current year or over 4 years and nothing in year 5. Does that make sense?
Yes, sir.
Okay, that's looking at the tax treatment of it. Okay, so that means if you're writing off more, okay, you'd be getting a tax benefit. Okay, so that'll be a tax benefit. Okay, because of the accelerated write-off. Okay, so the tax benefit of the accelerated write-off, you'd be writing off the asset in 4 years instead of 5 years. So the wear and tear is going to be this divided by 4 years, not 5 years. Okay, so that would have been your wear and tear. Okay, so in actual fact, you've only written off 602,400. You didn't write off the 75300, which you would have in terms of tax. So the benefit would have been the difference times the tax rate. The tax benefit would have been the difference times the 28%. Okay, so the difference here would be this minus that times 28%. Okay, which is the tax benefit of 42,000, which you would get as over 4 years, and that would then, if it's a tax benefit, you end up paying less tax. So if I end up paying less tax, my net profit will go up. So it'll increase your operating cash flow.
Yes, sir.
Okay, but then in year 5, okay, do you agree in year 5 you don't receive that benefit because you don't get that tax benefit? Okay,
yes,
so
sir.
in year 5 there would be a tax disadvantage. See, this is just something additional that I'm considering just because they mentioned it in the question. I don't think you have to, but I'm just putting it in just in case. Okay, so the tax disadvantage, which would be, well, from an accounting point of view, you would have written off depreciation of 602. From a tax point of view, the asset has been depreciated, you wouldn't get any tax benefit. Do you agree?
Yes, sir.
Okay, so you're basically taking out the effects of the tax, which is the disadvantage that you're adding back. Okay, so the full 602,400 times 28% would be a disadvantage that you would have to reduce from your operating cash flow. Okay, so I'm just going to show OCF. OCF here after taking a more complex tax consideration is, okay, these figures here. So it'll be this plus the benefit minus the disadvantage. Okay, it would be that. Okay, taking that other thing into consideration. Okay, but I don't think they're doing it that way. I could be wrong, but I've shown both. That's without taking the difference in wear and tear in 4 years. Let's just say 4 years versus 5 years. Okay, so the one I am taking it into consideration and the other I'm not. Okay, then I've looked at point 4. 5. Management requires 16%. There's your rate that you're going to discount your future cash flows back in time. All cash flows including concerned at the beginning of the year, okay, and at the end of the financial year concerned. Okay, that's fine. That's just a normal cash flow, and then they gave you those things. All right, so I drew this up. Okay, I'm going to work out IRR based on what I've got here. Okay, and then I'm going to do the NPV calculation. Okay, the NPV calculation will be initial investment minus present value of your future cash flows. Okay, which was given in the question. Where is it? There's it. The present value of the cash flows of purple. Oh, that's purple. That's purple. Okay, so that's purple. Okay, so purple. Purple, what is purple's initial investment? 3880 plus 150.
Yes, sir.
Okay, so initial investment for purple is 3880,000 plus 150. Close brackets minus the present value of their future cash flows, which was what? There, 3991,076. 3991,076 equals. Okay, it gives me 38. So this is positive. This is positive.
Yes. 924.
NPV greater than 0. Okay, do you see that?
Yes, sir.
Okay, purple IRR equals given equals 15,63. Okay, so all I need to do is just work out the pinks. Okay, so that's purple. Okay, let's delete this. Let's move this down. Pink NPV equals pink IRR. Okay, so let's do the calculation. Y0, Y1, Y2, Y3, Y4, Y5. Okay, year 0 has an initial investment of, where did I put the initial investment? Here's it. 3.5 plus 100. Okay, in year 1, oh, that's initial investment, that's negative. So minus. In year 1, your cash flow, okay, I'm going to do 2 calculations. I'll do it for both. I'm going to start with this one. Okay, this is without taking. And then I'll do another one. Let me just copy this. I'm going to put on the right here. And I'm going to use the after taking. Okay, so that's the one cash flow. Year 2's cash flow was that. Years 3 was that. Years 4 was that. Year 5 was this plus the terminal cash flow. Where's the terminal cash flow? There. The 488. Oh, hold on. It's 488 after tax. Okay, so this 488 less tax. Does that make sense?
Yes, sir.
Okay, so tax on 488 is 28%. So 488 times 28% is that. So after tax amount is this minus that gives you that. That's your terminal cash flow. Okay, so 31536. So this year 5 will be the OCF in year 5 plus the terminal cash flow in year 5. Okay, there's it there. Now I've got my system of cash flows. Okay, then I insert I as how much? They gave it to us in the question, 16%. Solve for NPV. Okay, and then in this one, I'm going to have these cash flows. That, and then year 5 will be this plus the terminal cash flow after tax. Okay, insert I at 16% and solve for NPV. Okay, so this is where I grab my calculator. I go to my cash mode. 16% rate. Cash flow here is what is the cash flow here? Negative 3.6. 926,400. 926,400. 926,400. How many? 3 of them. 1, 2, 3 of them. And then 104,880. 156,5760.
I got 194,686.
Negative.
Yes, sir.
Yes.
311.
Okay, that's good. And then let's try the other one. Okay, the other one here, I've got 968,568. I've got 109,0968 and 139,7088. Net present value solve. Minus 156,999.5647. Okay. Alright, so look at this. Pink doesn't look good. Purple looks the best.
Yes.
Okay. Oh, we also need the IRRs. Oh, I should have worked out the IRR for the other one. It's fine. Let me work out this one now quickly. Okay, so IRR for this thing. Pink IRR here is 14.22004924%. And then pink IRR here. So it doesn't actually matter which way you do it. You could have taken the different cash flows in terms of the tax into consideration. You still get the same conclusion. You still get negative NPVs for both. So I don't think it would have made a difference in the actual question. Okay, so let's do this one again. 926,400. 104,8800. 156,5760. 5760. Escape, solve. IRR comes out to 13.83954.508. Got that?
Yes, sir.
Yeah. Okay, so that's basically what you've got here. What else did they ask for in the question?
So determine the IRR.
Determine the IRR for pink, we did. And they even told us it's between, interpolate between 15 and 18%.
Yes, sir.
Interpolate between 15 and 18%. Did I leave something out? Let's go back and check. Cost price, working capital. Oh, working capital will be returned at the end of the project. That's something I forgot. Okay, remember working capital, you invest initially and then it gets returned at the end.
Yes, sir.
Okay, so we need to add another terminal cash flow here. Working capital returned, WC returned. Okay, so how much working capital did I have at the beginning? 100,000. 100,000 will come back at the end. Okay, so we need to add an extra 100k here. Plus 100,000. Plus 100,000. Okay, so I just want to put a note here. This is the OCF plus the TCF plus the WC returned. Okay, so now let's redo that calculation. Go back to the NPV. Okay, so my final cash flow is actually 1665760. %, in I, solve for NPV. NPV, okay, it's still negative though, but it's smaller. It's 147,075.0098. Okay, if I solve for IRR for this one, $14.38795612. Okay, it still doesn't give us an IRR in between that range. Okay, because when I looked at the question, they say interpolate between 15 and 18%. That's why I'm thinking that the rate must be between 15 and 18%. See, that's why I'm redoing the calculation. Show detailed calculation of the NPV of pink as well as the interpolation calculation at 15%. Make a recommendation to management based on the IR of the two machines. Okay, so that's all they've given you in the question. Okay, so the only thing that we could do to improve the answer is include the working capital here at the end, because that's returned to the business afterwards. Okay, so you incur the cost at the beginning and then you return it at the end. Okay, let's just change these workings here. 16%, 968568. Did I put 100,000 in the year? I did. Okay, so 149,149,7088. Escape, net present value here comes out to 109,388.2632. Okay, so let's see what we get here in terms of the rates. IR here comes out to, is it between 15 and 18%? Let's check. No, it's still under. It's 14.77553019. Okay, so it's still less than what it's supposed to be in terms of, I'm just looking at the guide from the question. The question is telling me to use between 15 and 18%. So I would expect the answer for IRR to be between 15 and 18%. But it's not the case here. We did add the benefits. Let's just check. Yeah, I did add them. The tax benefit, we add back the depreciation. Yeah, it seems fine. Okay, I'm going to leave it as is, and then we've got the last bit, which is the recommendation. Based on the IRR of the two machines, which machine would you accept? Okay, so obviously pink IRR. Remember pink IRR, we had two.
Yeah. Yes, sir.
We had one taking the tax consideration, and we had one without taking the tax. The IRR with was that, without was that. Okay, and then we had purple. Purple IRR was given as this. Alright, so obviously recommendation would be accept project purple. Why? Oh no, actually you wouldn't. Reject both. Why would you reject both?
Is it because they don't fall between the...
IRR is less than cost of capital.
Oh, okay.
It's less than the 16%. Where's that 16%? Here's it. See.
Yeah.
Management requires 16% after tax return on capital. It's not greater than 16%.
Yes, sir.
Okay. Okay. Right, the last one, calculate the profitability index of purple. That's easy. We just need the formula for it. This is something that we did in DSC. So this is C. Purple profitability index equals brackets net present value plus initial investment, close brackets, divide by initial investment. Remember that?
Yes, sir.
Okay, so do we have purple's net present value? Yes, we do. Okay, we had purple's net present value of 38924 plus the initial investment of, where was my initial investment? 3880000 plus 150. Close brackets. Divide by, open bracket, initial investment, 3880000 plus 150000, close brackets, equals. Okay, 3 marks working this out, 1.0096. Okay, I think the profitability index in your textbook was a slightly different formula. Let's just go find that one. There's it. Okay, in your textbook, the profitability index formula was this. Okay, which should give you the same answer. PI equals. They gave you the present value of the cash flows in the question, hey? Where's purple? There's purple. Present value of the future cash flows 3991
076.
Yes. Okay, so this figure. And then divide that by the initial investment.
Which is a 388.
Okay, so this divide by that gives you 3, 4, 5. What is that? Initial investment. NPV. Did I do this right? Let's just check here.
I got it right. The same thing, sir. But when I don't add,
Net present value is the other way around. It's present value minus initial investment. Sorry, I had my formula here the wrong way around. Sorry, that's the wrong way around. It's minus this. Okay, that's better. Okay, it's present value. I'm just going to put this in blue. Okay, it's present value of your future cash flows minus initial investment, not the other way around.
Yes, sir.
Okay, so it's this minus that. So if it's this minus that, then this comes out to negative 38942. Yeah, it actually should be negative 3 because remember, purple's IRR was 15.63, hey?
Yes, sir.
And 15.63 was less than 16%, so you would reject. Less than 0. Okay, so that needed to be corrected. Yeah, it was negative 38924 instead of positive 38924. Okay, because your IRR here was also less than 16%. Okay, we saw that earlier. Both projects were less than 16%. So the net present value needed to be negative. Okay, so then I need to fix this. Net present value here, I just need to put a minus here. Put a minus there. It's minus 38. And then put a minus here. Minus 38. And there we go. Now you get the same answer. Okay, yeah, so just be careful with the formulas. Make sure you use the right one. I used the wrong term first. It's present value of the future cash flows minus initial investment. That gives you NPV. Okay, other way around, not the initial investment minus. Okay, got that?
Yes, sir.
Alright, so that covers that question, the long one.